Canada's economy is on a hot streak.
The Bank of Canada has now raised its key interest rate by a quarter point, ending a 3-month conditional pause.
Those lending products that gets gauged off a prime rate is the variable rate mortgage. Those mortgages where the rates are, as the name says, variable.
There is so much chaos when it comes to interest rates. A lot of people call me and ask whether to go for variable or fixed. We all know that interest rates are very high and they might go even higher, but when would they come down? And I've talked about this in many videos. In that context, should we go for a 2-year fixed, 3-year fixed, 5-year fixed? A lot of banks are saying 5-year fixed are better, but there is an agenda behind it and we'll talk all about that, and I'll give you the exact blueprint of how to choose interest rates. So let's get started. So in today's video, we'll first be talking about what's the difference between fixed and variable rates. Then we'll be talking about penalties and how they are calculated for variable and fixed. And it's really important to understand penalties when you're taking a mortgage, because there is a very high chance as a first-time homebuyer that you have not bought your ultimate house and you will be breaking a mortgage. And it's very important to understand the penalties that you'll be paying when you break that. And then I'll be talking about when, and more importantly, who should choose a variable rate right now. And then finally, we'll be comparing 2, 3, 4 and 5-year fixed, and we'll be doing numbers, and I'll be cutting through all the chaos in the market based on numbers. First, let's talk about fixed versus variable and what does it actually mean. I'm sure all of you know that mortgage payments are divided into 2 parts. One is the principal payment, the other one is the interest payment. Now, if you take a fixed mortgage, your principal payment and the interest payment remains the same for the length of the term. So let's say you take a 2-year fixed or a 3-year fixed or a 4-year fixed. The number 2, 3 and 4 determines the term of the mortgage, and for that term, your principal payments and the interest payment remain the same, and by extension, therefore, your mortgage payment remains the same. However, for variable rates, it's slightly different. When interest rates go up, the principal payments remain the same every month. However, the mortgage payments will also go up because one of the principal and interest are going up, and therefore the mortgage payments have to go up. On the flip side, because interest rates are so high right now, in a couple of years when they start to come down, when interest rate go down, the principal payments remain the same, and therefore the mortgage payments also reduce. Now, obviously, this is a very simplistic calculation and there are 2 types of variable mortgages. I'll not talk about that in this video because this video is mostly about fixed mortgages and what should you choose. However, basically fixed mortgages have fixed payments for the term of your mortgage, and variable mortgages have variable interest, and therefore the mortgage payments can change with the interest rate change. And that's the basic difference between the 2. Now, like I said, when you're taking an interest rate, the first thing that you need to understand is your penalties and how they are calculated, because for fixed and variable, they are very different. Now, the first thing is, why would you break the mortgage? And the first reason why you would do that is you're selling the house, you're upgrading the house. The second one is you're refinancing the house. And the third one is you win a lottery and therefore you want to pay off your house and be mortgage free. Now, the second point that I discussed, refinance, have 2 reasons. One is that the interest rate, let's say in 2-3 years, have reduced so much and you want to refinance the entire thing before the term ends into a lower payment. The second reason is that you actually have a really good opportunity and you want to pull some money out of your house and you want to put that money into that opportunity. Now, for instance, let's assume that you're taking a mortgage of $700,000. So the loan, overall loan is $700,000 and you break the mortgage in 2 years. Now, let me explain how the variable mortgage penalties are calculated. Now, let's assume when you took the mortgage at a variable rate, the rate was 6.3%, which is the current rate right now as of recording this video in August. It's prime minus 0.9%, prime is at 7.2 and minus 0.9 will be 6.3. So if you go for a mortgage right now, your rate will be around 6.3. Now, these interest rates could be a little bit higher than what I can actually give you if you were to call me today. However, don't go by the actual interest rates, go by the differences that I'm talking about. So let's assume the interest rate is 6.3% in 2 years. Because interest rates will come down, the 25-year average of interest rates, and I've talked about this, at length, is less than 4%. So let's assume in 2 years, the interest rates go down to 4%. And that's when you decide to break the mortgage. The penalty that will be calculated because you're making a 5-year variable rate, you're breaking a contract with the bank, will be 3 months of interest rate. What I mean by that is you multiply 4%, which is your rate at the time of breaking the mortgage, with $700,000, which is the mortgage amount that you took, divided by 12, that's your 1 month of interest. But you are paying 3 months of interest, so you multiply it by 3 months, and therefore you get a number which is $7,000, and that's the penalty, more or less, that you'll be paying if you break the mortgage, if the numbers look like this, which is very realistic in my view. Now you must have heard that fixed rate mortgages are much more expensive to break. Let me show you how. Let's assume that you take a fixed rate mortgage at 6% right now, 3-year fixed. Now in 2 years, you decide to break the mortgage and the new fixed rate at that time, again, let's assume is 4%, just like we took in the variable. The penalty is something called as IRD, interest rate differential. Now let me just explain with an example. Now 6% was the original rate, 4% is the new rate that you are, when you are breaking the mortgage. So the bank is losing 2%. So they are taking money away from you because you broke the contract and they're giving it to someone else at 4%. So they're losing 2%. So they'll be charging you 2%, which is 6% minus 4% of your mortgage balance, which is $700,000. Multiplied by 1 year that you break the mortgage early. Because this was a 3-year fix, so the term was 3 years, you broke the mortgage in 2 years, the difference is 1 year, and that's how the penalties are calculated, and this comes out to about $14,000. Now this can be very different when you go for a different term, and we'll be talking about that in the subsequent slides, but that's how the penalties are calculated, just on a very, very simplistic level. Now, when I talk about interest rates, I always talk about the rip-off mortgages, and I'll talk about the mortgages which have really low interest rate. There are so many mortgages that you will see in the market. You open Instagram, you're buying a house, you'll find a lot of advertising for mortgages, and the interest rates are really low, too good to be true, but there is a catch to it. And the catch is that they are putting some fancy words in your fine print that would make you pay a lot of money when you break the mortgage. The first one is bona fide sales clause. This is, you cannot break the mortgage unless you sell the house. So there's no way to refinance the house. There's no way to take a HELOC on the house. The only way to get out of the mortgage is to sell the house. And that's a really bad mortgage to go into in a high interest rate environment where there is a very high chance that interest rates will go down in a couple of years. Then you would want the option of refinancing, especially when you buy today when the house prices are lower because of high interest rates. And when the interest rates start to go down, the house values will increase, and therefore you would want the option of taking out the money, and refinancing would be a really good thing, not just to reduce interest rates, but to build your wealth in future. And that's something that you should stay away from. The second one is not a full feature mortgage, especially portability. Now what portability means is that you would want an option. Let's say you buy a house right now, in 2 years you want to change the house because you're upgrading, because you're going to a bigger house, because you're making more money, because the interest rates are lower, and you just want to move into a bigger house. There are mortgages where you will not be able to take the same mortgage to the new house. That's called portability. You can take the same mortgage into the new house. The reason why I do that is then you don't have to pay the penalty of breaking the mortgage, and you can just pay the legislation fee of $300, $400 and save on thousands of dollars of penalty that we talked about in the previous slide. So that's a full feature mortgage, and there are some rip-off mortgages that do not have those features. The third one is reinvestment fees, and that's a really small fine print in some mortgages where not only do you pay the penalties that I talked about in the previous slide, but you also pay 1, 2, 3% of your outstanding balance as reinvestment fees. And that's something that you need to stay away from. The fourth one is that there are certain mortgages where there are no prepayments allowed. So for instance, every good mortgage, every good bank would give you a facility of doing 15 to 20% of prepayments everywhere. Let's say you have a big bonus coming up and you don't know where to put the money. You can actually put it back into your mortgage and pay it down, or you can reduce the amortization. And that's a really good feature that every good mortgage should have, especially on your primary house, because you want to pay off your mortgage as soon as possible. I'm not saying you have to pay it off in 5 to 10 years, but you still want to have the flexibility of paying it down when you have additional money coming in. And the fifth one, it's actually called fully protected mortgage. And the reason why it's a rip-off is because they are adding on top of your mortgage a premium for your life. That's basically a mortgage protection plan that automatically gets added to your mortgage. I went to a big bank to get my mortgage done for the condo, and because I'm a mortgage agent, I understood that this is a rip-off, and they actually added full protection onto my mortgage. And that's the product that they presented to me. And if you are not from the industry, you can actually fall for it. So make sure that there's no additional payment on top of your mortgage when you're taking a mortgage. It's not required. And the sixth one, and this is a really important one, is a collateral mortgage to 125% of property value. Now, in order to explain this, let me go back to the previous slide. What collateralization means is that instead of calculating the penalty on $700,000, which was your original mortgage amount, they calculate it at your purchase value. Let's say that's $800,000, multiplied by 125%, that's $1 million, and that's how they recalculate the penalties to $10,000 instead of $7,000, and that's called collateralization. Same way for fixed mortgages, it gets worse because the same 800 multiplied by 125% into 1 year makes the penalties to $20,000. And again, this is actually done by the big banks as well. There is actually a way of reducing these penalties and collateralizing it to the mortgage amount and not to the 125% of purchase value, and that's where all these fine prints really infuriate me, and I make sure that my clients do not get a mortgage that they'll regret in future. Just to give you an idea, when I got the mortgage for my first condo that I took, I was not a mortgage agent, so I was completely unaware of all these things, and my bank actually collateralized my mortgage to 125% of purchase value, and I had to pay a really big penalty when I was refinancing it, which is one of the reasons why I became a mortgage agent. Now let's talk about who should go for a variable rate mortgage. If you look at all the news articles, they're all saying that the rate cuts will happen in 2024. Some are saying June 2024, some are saying it will go down to 3% in 2025. But yes, it makes sense that the variable rates will go down closer to election. The variable rates have to go down in order to stimulate the economy, and that will happen once we are out of this limbo or the recession that we are going through right now. And yes, interest rates will come down. So should you go for variable rates then? But on the flip side, there's a very high chance that the interest rates will go even higher. The prime rate is at 7.2. Most of the mortgages, if you're taking an insured mortgage doing a less than 20% down, will be at 6.3 as of today if you're taking it today. But there's a very high chance there will be a couple of interest rate hikes in 2023 before the interest rates start to come down in 2024 and 2025. And therefore, the confusion happens whether to go for a variable rate mortgage to save on the penalties or not. Now, in general, I do not recommend that, but there are certain cases where I would say that you can consider. Number one is that you are buying way below your means. And the reason why this is important is because if you're buying, let's say your house value or the house, related expenses are 50% of your overall, net income that you're getting. Don't go by the gross income, go by the net income. If it's 50%, then even if there is a couple of interest rate hike, you will actually reach 55, 60% and you will be strangled for cash. And therefore, if you're buying way below your means and your overall household expenses right now on current interest rates are less than 35%, only then go for a variable rate mortgage. The second reason why you would go for a variable rate mortgage right now in this market is you are house hacking. Your basement is on rent. Overall expenses for the house are reduced because the basement is on rent. And by extension of that, your rule of 35 actually makes a lot more sense. The overall expenses, including the basement rental, is actually less than 35% of your overall net income. And therefore, variable rates could be a way to go because increasing the variable rates, increasing the payments would not actually impact you too much. And the third reason why you would go is you're renovating. And the reason why it's important is if you're renovating something and then you want to refinance in 1 year, you want to pay the lowest possible penalty, which is only done on a variable rate right now. Or you go for a 1 year fix, which in my view is very, very expensive because we don't know if the economy will recover in 1 year, but we are almost certain that it will recover in 2 to 3 years. And that's why if you're renovating and want to just refinance and take the money out that you put for renovations in 1 year, then you can go for a variable rate and then decide based on the market next year what you want to do, whether you want to go for fixed or variable. Now let's talk about fixed rates because that's what people are taking. That's what most of my clients are taking, and I do a simple calculation to make them understand what you should go for. Now let me do these calculations. Now we need to understand this. Banks are making they are making a ton of money selling 5-year fixed right now. I as a mortgage agent get paid more. They as a lender lock you in for over 5% interest rate for 5 years, and therefore, yes, they might be making less money in the first 2 years, but they'll be making bank after the interest rates start to come down and the overall interest rates in the market are 4%, but you are still paying over 5%, and that's where they'll make most of their money. So let's do the calculations and compare 2, 3, 4-year fixed and 5-year fixed, and then let's see what's the cost of taking each of these mortgages. Now, this one can be a very complicated calculation, so just bear with me and I'll try to make it as simple as possible. So let's assume that you take a mortgage of $700,000 and irrespective of what you take, the mortgage obviously remains $700,000. Now, if you go for a 2-year fix, 3-year fix, 4-year fix, 5-year fix, the interest rate will be 6.5%, and this is as per today. It can be very different when you are watching this video. It can be very different, 2 years from now, 1 year from now, even 1 month from now. But just, understand the differences. Don't go by the interest rates, exactly. Just understand the differences here. So the current interest rate for 2-year fixed is 6.5%, 3-year fixed is about 6%, 4-year fixed is about 5.5%, and 5-year fixed is about 5.25%. So a lot of people are actually getting baited into the 5.25%, thinking that the payments will be lower, and that's in fact true. If you go for a 3-year fix, the payments are $4,479. If you go for a 5-year fix, the payments are $300 lower, and it's completely fine to be baited into that. But the problem that I have is most banks are only pushing 5-year fixed. Very few people in the banks are pushing 3-year fixed, because honestly, if you're working for a bank, the bank has to make more money, and the bank makes most money when they sell 5-year fixed. They will give all the mortgage agents more incentives. Just like me, I get a lot of incentive in selling the 5-year fixed, and I don't like that. And I'll tell you in a minute why. Let's assume in 2 years you're breaking this mortgage, because most mortgages break in 2 years. In 2 years, interest rates will come down, and most mortgages will also refinance in 2 years. Now, if you break a mortgage in 2 years, in those 2 years, you would have paid an interest on the principal amount that you took, which is $700,000. That interest in 2 years with high interest rates is almost $86,000. It's shocking, but that's the amount of interest that we are paying if you go for a 2-year fixed, $86,000. If you go for a 3-year fixed, which is what the most popular mortgage is right now, it's about $79,000. If you go for a 4-year fixed, it's $72,000, and so on and so forth. But the difference between the highest and the lowest, or let's say a 3-year or a 5-year, is about $10,000. So obviously you are paying a lot of interest, and this actually makes us feel that 5-year fixed could be a better rate to go for, because you're paying the least amount of interest. But bear with me for a minute. The outstanding balance would not be very different if you look at it. It ranges from $669,000 to $673,000, because you have paid the mortgage down in all this time, in 2 years. So that's not very different. So you'll end up almost at the same level. Now let's assume when you are breaking the mortgage in 2 years, the new rates are 4.5%. They have actually reduced by about 2% across the board. So 6.5 has become 4.5, 6 has become 4, 5.5 has become 3.5, and 5.25 has become 3.25. Now, it could be completely wrong. I could be very hypothetical. But again, look at the differences, right? Do not look at the absolutes, look at the differences. The penalties, if you are breaking a mortgage in 2 years, obviously if you have taken a 2-year fixed, you pay 0 penalties, because your 2-year term is up. You can now refinance into a 4.5, or you can just, renew at a 4.5, whatever the interest rate is, or you can renew into a 3-year fixed, variable, whatever you want to do, but you will not be paying any penalty. Now, based on the calculation that I told earlier, you will be paying a 1-year penalty on a 3-year fix. That's 6% minus 4% multiplied by $700,000. That comes to $14,000 for that 1 year. If you break a 4-year fixed mortgage in 2 years, you pay double the penalty, because the number of years have increased to 2 times. So that's $28,000. If you break a 5-year fixed mortgage in 2 years, you pay 3 times penalty, and it comes to $42,000. So if you compare a 3-year fixed and a 5-year fixed, yes, you pay $10,000 less interest over the course. However, you do end up paying almost $28,000, 3 times more penalty if you break the mortgage early, which is the reason for my title, Banks Are Making Bank on 5-year fixed, and we don't see it today, but we will see it in 3 to 4 years from now. Now, should you go for a 5-year fixed at all? And the answer is yes. If you're not qualifying at a 3-year fixed and you really want that house, you can go into a 5-year fixed, but there's one caveat to it. You cannot break the mortgage. Because if you don't break the mortgage, and if you see through the 5 years, I'll explain you and prove you with numbers that your overall interest that you pay over 5 years will be no different than someone who took a 3-year fixed and then refinanced or, reduced their rate to, let's say, 2% lower. Overall, they'll be paying almost the same amount of interest as you would be if you take a 5-year fixed. But again, the caveat is you cannot break a 5-year or a 4-year fixed mortgage, because the penalties that you pay will erode a lot of your equity. So let's look at the numbers. Let's say we do not break the mortgage until the term ends. So if you take a 2-year fixed, you do not break a mortgage in 2 years. If you take a 4-year fixed, you do not break the mortgage for 4 years. And in the 5th year, you actually break the mortgage, or you just renew into a lower rate. And again, for 5 years, you just keep the same 5-year mortgage for 5 years without breaking it. Now, after the term ends, the interest rate, let's assume, is 4%, and the overall payments reduce from whatever it is right now to about $3,500. Now, let's look at the total interest that you pay for 5 years in each of these cases, and you will see that it's not very different. From $161,000 to $170,000, the overall spread is less than $10,000 across 5 years. That's less than $150 a month. And the difference is actually really low if you look at a 3-year fixed and a 5-year fixed. Now, 3-year fixed is the most popular. Most of my clients are taking 3-year fixed right now. Now, there's a case to be made that 2-year fixed is better, because if you look at these numbers, 2-year fixed is better. But again, 3-year fixed just gives us a slightly lower interest rate and the payments are just at the sweet spot. But if you look at this number and this number, you will see that the difference between the amount of interest that you pay is not very much. What I mean by that is, if you keep this mortgage for 3 years without breaking it, and for the remainder of 2 years, versus someone who has taken a 5-year fix, that for the remainder of 2 years, you get a 4% interest rate, you still end up paying $168,000 in interest in 5 years. Versus if you were not to break a 5-year fixed mortgage and you were at 5.25% around, you'll only be paying $2,000 more in interest across 5 years. And again, the caveat is that you cannot break a 5-year mortgage. And therefore, I really believe that 5-year fix is a good mortgage to take if you don't want to break the mortgage for the next 5 years. However, there's a study that shows that an average first-time homebuyer mortgage breaks in less than 2 years. The exact number is 23 months. And therefore, I would never recommend taking a 5-year fixed if you are a first-time homebuyers. Very few of my first-time homebuyer clients are taking a 5-year fixed, and those people will keep the house for 5 years. They don't want to break the mortgage for 5 years. And therefore, my recommendation is to go for a 2 or a 3-year fixed if you're planning to upgrade in the next 3 years, which will be the case with most of you. I hope you like this video. I hope these numbers made sense. And if you like this video, do hit the like button, do share it with someone who is also in a similar boat or buying a house and then figuring out whether to go for a variable fixed or what kind of fixed. And if you really want to understand your situation, because this generic situation can be very different from your situation, do book a call from the description. It's a free call. The team will call you or I will call you, and we will talk about your particular situation and we'll make a strategy and give you a product that's suitable for you. And when you work with us, you are getting into a 30-year relationship. It's not about that one mortgage. My objective is to retire all my clients with $5 million of net worth, and depending on how much time and energy you want to spend on yourself, you can actually do that in the next 10 to 15 years. That's all I have for today. मिलते हैं अगली वीडियो में, तब तक के लिए bye bye.